Welcome to the deep dive. It feels like we're just drowning in information these days, doesn't it?
It really does. Especially trying to make sense of fast-moving areas like, well, specific stock market sectors.
Exactly. It's tough to cut through the noise.
And that's what we're trying to do today. We're going deep into the household and personal products sector.
Right.
We used a stock screener, set a price filter over $15, and picked out three really interesting companies. They kind of tell different stories within that same space.
Okay, so the mission today.
Basically, to pull out the key insights from all the data we've gathered on these three.
We want to explore their basic profiles, financials,
The why behind maybe recent stock moves or news.
and even a little what if. We'll do some fun paper money math just to illustrate, potential outcomes.
Yeah, fundamentals, technicals, news, sentiment, the whole picture, really.
Just trying to help you connect the dots.
Now, before we dive in, we absolutely have to say this. Everything we discuss today is purely for informational and educational purposes.
Super important.
It is not investment advice. Investing carries risks, always. So please do your own research or, talk to a qualified financial professional before making any decisions.
Definitely. We're just here to shed some light on what's happening in this sector.
Okay, ready to jump in?
Let's do it. First up, Hims and Hers Health Inc. Ticker is HIMNOs.
Ah, yes, HIMS. They're pretty new on the scene, relatively speaking. Founded 2017, based out in San Francisco.
And they've made a big splash in telehealth, right? Covering things like mental health, sexual health, dermatology, even primary care now.
Exactly. They're listed on the NYSE Consumer Defensive Sector, but specifically in that household and personal products industry group. And market cap is sitting around $11.38 billion.
Okay, so looking at the financials, wow, that PE ratio is 63.02. That screams growth expectations.
It absolutely does. A PE that high tells you investors are banking on, well, significant future earnings growth. It's not subtle.
And it looks like Hims has been delivering on that growth front, at least recently.
Oh, yeah. EPS for the last 12 months is 0.98 card. But check this out. EPS quarter over quarter jumped nearly 200%, up 198.06%.
Wow.
Sales are also climbing fast. Sales year over year for the trailing 12 months, up over 88%. And they're projecting EPS next year to grow another 38% or so.
They seem pretty efficient operationally, too. Profit margin at 9.62%, gross margin 67.11%. That's solid.
Very solid margins. And return on equity at nearly 42% shows they're using shareholder money effectively.
But then you see the other side, price to sales at 5.65, price to book over 20.
Right, those definitely flag it as a growth stock, not a value play. You're paying a premium for that expected growth.
What about the PEG ratio that compares the PE to the growth rate?
It's 2.47. So, it suggests growth is definitely priced in, but maybe reasonable if they hit those high EPS forecasts. It's a big F.
Okay, so fundamentally a high growth story with high expectations baked in. How's the stock actually been performing? Let's look at the price action.
Okay.
Currently around $50.35.
Yeah, and the 52-week range tells a tale. It's been as low as $15.73 and as high as almost 73.10.
So it's pulled back quite a bit from the high, down about 31%.
But still up massively from the lows, over 220%.
The performance numbers are pretty wild, too.
Absolutely. Year to date, it's up over 108%. For the full year, over 203% gains. Huge.
But the last quarter shows a dip, down 15%, a pullback.
Seems like it. Looking at the technicals, the price is actually above its 20-day moving average right now by about 7%.
Okay.
But it's just slightly dipped below its 50-day moving average by less than 0.5%. Crucially, though, it's still well above the 200-day average by almost 19%.
And the RSI, Relative Strength Index.
It's sitting at 52.55, so pretty neutral, not indicating overbought or oversold right now.
So with all that, what are the potential triggers here? Buy, sell.
Well, that's the key question, isn't it? The 200-day is often seen as strong long-term support, and it's holding well above that. That's positive.
But the dip below the 50-day?
Yeah, that could signal some short-term weakness, maybe just cooling off after those big runs. For some traders, a strong move back above that 50-day might be a buy signal, suggesting momentum is picking up again.
And on the downside?
If it were to break below that 200-day average convincingly, that could be a sell trigger for many, signaling a deeper correction might be underway.
And you really have to factor in the volatility here.
Absolutely critical. Weekly volatility is near 8%, monthly over 6%, that's high, and the beta is 2.22.
Meaning it moves more than twice as much as the overall market, on average.
Exactly. High risk, potentially high reward. not for the faint of heart.
Okay, shifting gears a bit. What about recent news? What's been driving sentiment?
It's actually been a real mix. On the one hand, you had that FDA warning letter just recently, September 16th.
Mm-hmm.
That definitely hit the stock. It dropped over 5% that day.
That sounds serious.
It is. Regulatory scrutiny is always a risk, especially in healthcare. But then, almost in the same breath, you see news about them expanding into AI, digital care, launching new products like testosterone offerings for men.
So expansion continues despite the warning.
Seems so. And there's that whole ongoing narrative around weight loss drugs and Hims' role there, which has included some legal tussles with Eli Lilly in the past.
What are the analysts saying amidst all this?
The overall recommendation rating is 2.82, which is kind of a hold, leaning towards buy maybe. It's a bit mixed.
Okay.
We saw some downgrades earlier in the year from Needham and TD Cowen, though Needham did reiterate a buy with a higher target more recently too. The average target price is pretty much where the stock is now, around $50.66.
Anything else catching your eye in the news flow?
Well, yeah, the insider selling. It's quite significant. The CEO, Andrew Dudum, and other execs have filed plans to sell millions worth of stock in August and September.
What do you make of that?
It's always tricky. Executives sell for many reasons, diversification, taxes. But when you see large amounts proposed around the same time, some investors interpret it as insiders thinking the stock might be fully valued or wanting to lock in some profits after that huge run-up.
Yeah,
It's a data point to consider.
definitely. Okay, let's do that paper money math for Hims. Say you put $5,000 in a year ago.
Right. With the stock up over 203% for the year, the price back then would have been roughly $16.56.
Okay.
So your $5,000 would have bought you about 301, maybe 302 shares?
And at today's price of around $50.35.
Those shares would be worth, let's see, about $15,200.
Wow. So a paper profit of roughly $10,200?
Yep, a return of about 204%. Pretty incredible performance over just 1 year.
And just for context, those 30002 shares are a tiny fraction of the company, right?
All minuscule. About 0.00014% of all the shares out there, and worth about 0.000013% of the total market cap. A great illustration of that growth potential playing out.
Okay, let's pivot now. Totally different company profile next. Kenvue Inc., ticker KVUE.
Right, Kenvue. This is the consumer health business spun off from Johnson & Johnson not too long ago, February 2022.
But the brands are household names. Aveeno, Band-Aid, Listerine, Tylenol, Neutrogena.
Exactly. Very well known, established products. It's also in consumer defensive, household and personal products, but much bigger than Hims' market cap, around $35.2 billion. And it's in the S&P 500.
Now, Kenvue's story lately seems heavily influenced by external events, doesn't it?
Oh, absolutely. That news in early September about RFK Jr. potentially linking Tylenol, one of their flagship products, to autism, that was huge.
You saw the stock react immediately?
Yeah, reports said it wiped billions off their market value almost overnight. The company's been actively pushing back, lobbying against it, defending Tylenol's safety, but the damage to sentiment was clearly done. It really colors their recent data.
Looking at valuation is a stark contrast to Hims. PE is 24.92, forward PE around 16.3, much lower.
Much more typical of a mature, established consumer company, yeah.
Yeah.
And definitely reflects some of that recent pressure.
How are the earnings looking?
Well, EPS for the trailing 12 months is 74 cents rents.
Yeah.
But EPS this year is actually projected to be down about 9%. However, there was a big spike in EPS quarter over quarter, up over 600%, which might suggest some recent improvement, or maybe accounting adjustments. It's hard to say without digging deeper. Sales quarter over quarter were down slightly, about 4%.
What about the dividend? That's often a draw for these kinds of companies.
It is. The yield is attractive, around 4.5%.
Yeah.
But the payout ratio is over 150%.
Meaning they're paying out more in dividends than they're currently earning.
Exactly. That's generally not sustainable in the long run unless earnings really pick up or they decide to cut the dividend, something income investors definitely need to watch closely.
Despite those headline issues, how do the underlying margins look?
Actually pretty decent for this type of business. Return on assets is over 5%, return on equity nearly 14%, gross margin is strong at 58%, profit margin over 9%, solid operational metrics.
And the valuation ratios compared to Hims, PS, PB.
Much lower. PS at 2.32, PB at 3.28. Reinforces it's not priced for high growth like Hims.
And the PEG ratio reflects that too.
Yeah, PEG is high at over 11, mainly because the projected long-term EPS growth is pretty slow, just over 2% annually for the next 5 years. It fits the profile of a mature company facing some significant current headwinds.
Okay, let's look at the Kenvue chart. Price action. Current price, $18.34.
Right. And the 52-week range is $17 and $15.25.17. So it's trading much closer to its low than its high right now.
Down over 27% from the highs, only up about 7% from the low.
And the performance numbers just show red across the board. Down almost 22% over the past year, down 14% year-to-date, down over 13% just in the last month.
A clear downtrend then. How do the moving averages look?
The price is well below all the key ones, about 7.7% below the 20-day, over 12% below the 50-day, and nearly 17% below the 200-day. That's technically pretty weak.
And RSI?
It's low at 32.72, getting close to that 30 level, which is often considered oversold.
So for a stock like this in a downtrend nearing oversold, what does that suggest?
Value trap. Contrarian buy.
It's a tough call. For contrarians, that low RSI might seem like a potential short-term buy trigger looking for a bounce. But
the consistent negative performance and being below all those moving averages is a big caution sign. It could just keep heading lower. The sell signals would have triggered earlier as it broke support levels. For anyone holding, continued weakness is obviously a concern.
it's less volatile than HIMS, though, right?
Oh yeah, much less. Weekly volatility around 3.7%. Beta is only 0.76, so it's generally less jumpy than the market. Makes those recent sharp drops seem even more significant for this particular stock.
Besides the Tylenol issue, any other major news affecting Kenvue?
There's been quite a bit happening, actually. They had a CEO transition back in July. They're also doing a strategic review, trying to figure out how to boost shareholder value.
And activist investors are involved now?
Yep. Sachem Head took a stake in August. That often means pressure for changes, maybe asset sales, cost cuts, strategic shifts. Could be interesting to watch how that plays out.
And they also cut their sales forecast recently.
Right, in August. That didn't help sentiment either. Analysts have a recommendation rating of 2.6 here, kind of a hold. Some recent downgrades, the one upgrade earlier in the year. The average target price is $22.32, so analysts see some potential upside from here. But clearly there are challenges.
Okay, paper money math, time for Kenvue. Same $5,000 invested a year ago.
All right. Performance over the year was negative 21.59%, so the price a year ago would have been around $23.39.
Meaning your $5,000 bought roughly 214 shares.
About 213.7 shares, yeah.
Yeah.
At today's price of $18.34, those shares are worth approximately $3,918.
So a paper loss of about $1,082.
Correct. A negative return of around 21.6%. Quite the opposite experience from HIMS. It really shows how company-specific news and challenges can impact even established brands.
And again, those 214 shares are a tiny speck.
Absolutely tiny. About 0.000011% of the shares in the market cap.
Okay, third and final company. A true giant. Procter & Gamble.
PG.
Ah.
P&G. Doesn't get much bigger or more established in this space. Founded way back in 1837.
Just think of the brands. Tide, Pampers, Gillette, Crest, Bounty. The list goes on and on.
Exactly. Across beauty, grooming, health, home care, baby care, they're everywhere. NYSE listed, part of the Dow Jones Industrial Average and the S&P 500. Market cap is enormous. $375 billion.
And the valuation reflects that stability, right? PE is around 24.6, forward PE near 21.6.
Yep, very much in line with a mature, stable blue-chip company. Predictable earnings power.
How are the financials looking?
Rock solid. EPS trailing 12 months is $6.51. Sales are massive, over $84 billion.
Growth isn't spectacular, but steady.
Exactly. EPS this year projected up maybe 2.4%, next year around 6.3%. Sales up 1.7% quarter over quarter. It's steady, reliable growth.
And the dividend is a key part of the P&G story.
Absolutely. Estimated dividend is $4.29, yielding about 2.7%. The payout ratio is a very healthy 62.6%. This is a classic dividend aristocrat. They've raised their dividend consistently for decades. Huge appeal for income investors.
Their operational metrics must be strong, too.
Top notch. Gross margin over 51%, operating margin over 24%, profit margin almost 19%, returns on assets, equity, invested capital, all excellent. Shows really strong management and brand power.
Valuation ratios like PS and PB. Higher than Kenvue, but lower than HIMS.
Precisely. PS is 4.45, PB is 7.33. Reflects that blend of stability, quality, and consistent performance. The PEG ratio is nearly 5, which again points to that slower, steadier growth expectation.
Okay, let's check the technicals for PG. Current price is $160.33.
Right. 52-week range is about $150 to $180. So, like Kenvue, it's closer to its low than its high, down about 11% from the peak.
But it's up almost 7% from the low. How's the recent performance looked?
Actually, short-term momentum looks positive. Up almost 2% this week, nearly 3% this month, and just over 1% for the quarter.
But longer term?
Still down. Over the past year, it's down about 8%, and year-to-date down about 4.4%.
How about the moving averages?
It's currently trading above its 20-day and 50-day moving averages, which is positive short-term, but it's just slightly below its 200-day moving average by about 2%.
And the RSI?
RSI is 59.13. So comfortable territory, not overbought.
So positive short-term momentum, but bumping up against that key 200-day average from below. What's the potential signal there?
Yeah, that's an interesting spot. For long-term investors, seeing it consolidate and then decisively break above that 200-day could be seen as a positive signal, maybe a buy trigger confirming strength.
And if it fails to break through?
If it keeps hitting resistance there and turns it back down, it might just signal more consolidation or sideways movement is likely. It's less about dramatic sell triggers with P&G usually.
Because it's so stable, low volatility.
Exactly. Weekly volatility is super low, like 1.3%. Beta is only 0.37. This stock just doesn't swing wildly like Hims does. It's built for stability, a defensive anchor in a portfolio.
What's the latest news around P&G? Still innovating, I assume.
Definitely. They're always launching new things, like those game scent boosters expanding Downy lines. Innovation is key to maintaining market share.
But even P&G faces external pressures, right?
Oh, for sure. The big one mentioned recently is tariffs. Multiple reports in August highlighted how tariffs are starting to squeeze profits for companies like P&G, potentially forcing price increases.
So even a giant isn't immune to macroeconomics.
And not at all. P&G even issued a specific tariff warning back in August. It's a reminder that global factors impact everyone.
How do analysts view P&G overall?
Generally very positive. The recommendation rating is 2.0, which is basically a buy. There were a couple of downgrades earlier in the summer, but the overall sentiment remains strong. The average target price is up around $172.
And the dividend reliability is always a plus.
Huge plus. And while you do see insiders selling, like the CEO selling shares, with a company this size and age, it's often just part of planned compensation or portfolio management, less likely to be seen as a major red flag compared to, say, a young growth company like Hims.
Okay, final paper money math for P&G. $5,000 invested a year ago.
All right. Performance for the year was negative 7.9%. Current price, $160.33. So the price a year ago was about $174.08.
Okay, so $5,000 gets you maybe 28 or 29 shares.
Around 28.7 shares, yeah. At today's price, those shares are worth about $4,600.
Representing a paper loss of about $400.
Correct. An 8% negative return on price.
Yeah.
Of course, you would have collected dividends too, which offsets some of that, but it shows even the most stable stocks aren't guaranteed to go up in the short term.
And those 29 shares are, again, an infinitesimal piece of P&G.
Absolutely minuscule. 0.000001% of the shares in market cap. Really highlights the scale difference between these companies.
Okay, wow. So we've looked closely at Hims, Kenvue, and P&G. Free companies in the same sector, but man, what different stories. What are the big takeaways when you put them side by side like this?
It's just fascinating, isn't it? You really see three distinct archetypes. Hims is your classic high-growth, high-volatility disruptor, betting on innovation, telehealth expansion, but facing risks like regulation and that high valuation. Huge potential upside and downside.
It's on P&G.
P&G is the polar opposite almost. The stable, blue-chip giant. Lower growth, but solid profitability, reliable dividends. A defensive play, though still subject to things like tariffs impacting margins. Predictability is its strength.
And Kenvue is stuck in the middle somehow.
Kinda, yeah. It's got the established brands like P&G, but it's going through major growing pains post-spinoff, dealing with that big reputational hit from the Tylenol news, management changes, activist investors pushing for change. It's a turnaround story, full of uncertainty, but maybe potential value if they can navigate it.
So for you listening, what this really shows is that even within one sector, household and personal products, you have vastly different investment philosophies represented.
Exactly. Aggressive growth, a complex turnaround situation, and rock-solid defensive income. Each comes with its own set of opportunities and risks and reacts differently to the news and market conditions we've discussed.
We've definitely covered a lot today. From Hims's rapid ascent to Kenvue's recent struggles and P&G's steady presence. It really underscores how innovation, news, economic factors, leadership, it all weaves together to shape a company's journey in the market.
It really does. And maybe here's a final thought to leave you with. Looking at these three very different paths within health, personal care, and household goods, what trends do you think will be the most powerful forces reshaping this whole sector over, say, the next 5 years? Will it be the continued rise of telehealth and digital disruption like we see with HIMSS? Will it be about legacy brands like Kenvue's facing new challenges or finding new life? Or will global economic pressures and things like tariffs impacting even giants like P&G be the dominant factor defining who wins and loses?
That's a great question to chew on, something to think about as you reflect on what we've discussed today. We hope this deep dive gave you some valuable perspective on this dynamic sector. Thanks for joining us.